thanks. First of all, thank you all for joining and joining us this morning. It's a pleasure to see you all. Just wanted to give you kind of a little bit of kind of the structure of today's webinar. You're free to ask any questions that that come to mind. Please type them into the chat. Both I and Esteban, who's here with us, will get those questions over to Dohn. We're going to send those questions over to Dohn after he gives his presentation. If there's a question that you're just dying to get answered and we don't get to it, just raise your hand and I'll make sure to keep an eye out on make sure to get that question answered. So we'll start with Dohn. Dohn will do his presentation, then we'll have a 15 or 20 minute Q&A. I know both Dohn and I, we can stay on beyond the hour if you need to get some questions answered. After Dohn's presentation, he's going to give you a link for you to be able to reach out to him to do a deeper dive in his presentation. And with that said, I think Dohn, I'll introduce him, Mr. Dohn Thornton, the infinite wealth strategist, but better known among his friends as the tax guy.
Can you give me
Dohn, take it away?
Can you give me I need to share my screen. Give me a co-host.
I'll do that right now.
All right. Give me 1 second here, and I will get rid of share my screen. Oops, I'm sorry about that.
Hey, Dohn, can I ask you a quick question? This is Samir.
Yeah, hi, Samir.
Hey, would you be also able to share your slides and all that stuff after this? I'm on my cell phone. I don't have access to a laptop.
Yeah, I had no problem. That's perfectly fine. Yeah. So
that'd be great. All right.
All right. So let me just get my presentation mode here, and we'll get started. So let's see, present, and yep. All right, here we go. All right, so I want to thank everybody for coming to this webinar. You're probably going to hear the passion in my voice. I love this strategy. This strategy is amazing. I have regret that I didn't know about it before. I had, last year, April was the first time that I was able. The previous year I was able to use this strategy in my real estate investing business. And it was an awesome experience, not having your accountant tell you no taxes owed. So it's crazy, amazing. And I love to tell people about it. So, buckle your seatbelts and let's get going here. Okay. So as I want to tell you that if you're here and you're not a real estate investor, it's okay, because you are going to be able to use the same strategies. I'm just making this real estate investor specific. The strategies will work for any business except for a W-2 employee. All right. So whether you're a business owner or you're an investor, I'm telling you right now that your tax, your asset protection, and your ownership strategies are absolutely obsolete, and they are costing you a lot of money. All right. So, but before, I have to make sure that the attorneys are happy when I read this disclaimer. I'm not a licensed tax advisor. I do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Okay, so now I paid my dues to the legal profession. I want to talk about the elephant in the room, and I'm sure that elephant's in your head too, not just in your room. For a lot of people, this is what they always say. Oh, it's got to be a scam, or you know what? It's too good to be true. It can't happen. There's no way that you can save all this kind of money and the IRS is not going to come after you. It's like, well, let me ask you this. There's this guy in the real estate investing community. It's called Grant Cardone. I don't know if you know him. He's got a jet. He's very, very famous in the real estate investing community. He uses this program. He uses the strategy. I don't think he's a scam artist, right? And for those of you who are in the know in real estate investing circles, Tim Mai he came on, he started the strategy earlier in the spring, and he's fully involved now in getting this out to people as well, because it's revolutionary. So I just want to tell you that these kind of people are out there. Now, for non-real estate, some of you may have heard about this guy called Jerry Jones. He owns the Dallas Cowboys. We know personally the guy that set him up on the policy, and I mean not the policy, but the trust and the system. So he uses this. So what I'm trying to tell you is just relax. It's not too good to be true. The ultra rich have been using these strategies for almost 100 years, and if you're asking yourself, well, am I in the right place? You are, if you're paying too much in taxes, or you're paying any kind of capital gains taxes, if your assets are not lawsuit protected 100%, if for real estate investors, if you're using LLCs or land trusts or holding companies to take title to your properties, you really need this. And obviously for anybody who's using 1031 exchanges to avoid capital gains taxes, those are now obsolete. So if you're doing any of these things, then you're definitely in the right place. So think about this. Have you ever dreamed of using just one entity to take title on all your properties? I mean, ditching all those LLCs, land trusts, holding companies, never worrying about lawsuits anymore. Just not even if you're not at fault. I mean, I had an issue once for 2 years because it was just completely ridiculous. But I had to deal with it and pay $8,000 retainer to an attorney just to defend myself over nothing. So never losing sleep over potential lawsuits is great, and obviously reducing your tax liability to almost zero. If you've ever dreamed of that, we're going to get into it. But here's what I've noticed, and listen, I'm guilty 100% on this because I was doing it wrong myself, and most real estate investors have been doing it wrong for years. But you know what? It's not your fault. You simply didn't know any better, as I didn't know any better. So, I'm here as Robin Williams in Good Will Hunting, and you guys are Matt Damon. Okay, hopefully less violent than he was, but I'm going to show you it's not your fault. You didn't know any better, but there is a better way. And luckily for you, this is the way to saving all your money. Now, I just introduced yourself, and now Patrick introduced me, but I just want to reintroduce myself. My name is Dohn Thornton. I'm known as Dohn the Short Sale Guy because I spent 20 years as one of the nation's top investors in short sales. I helped well over 3,000 homeowners in my career. And so I have a little bit of experience in the real estate business. So I'm not just some fly-by-night newbie that just heard about something. So, but I tell you what, I was doing it all wrong. I was taking title to my properties in a land trust. I mean, at any given time, I had 50, 80 plus houses, if not more sometimes, where I was taking them in land trust. I was paying way too much in taxes. And I was carrying a $2 million liability policy because I was afraid of lawsuits. A contractor falling off a ladder, someone doing a slip and fall, someone looking at my house, whatever. You always worry about that. Plus, not to mention the predatory ones. So, but luckily, I discovered a secret strategy that the ultra rich have been using for 100 years, and I'm not exaggerating that. Rockefellers began using the same strategy in 1914, and they still do, by the way. So I implemented this strategy for my business as well as for myself personally. And you can imagine, I alluded to this before, you can imagine my delight when my accountant told me that I owed zero taxes. First time in my career that I didn't owe any taxes in my real estate business. So that was pretty good. That was pretty awesome. So, I only had to, I was able to put all my properties in one entity, one EIN number, one tax return. And I know investors. I talked to an investor who has like 1,200 units, and he was saying that he's paying like $35,000 a year just for filing stuff, accounting bills, and not anything to do with taxes. And so now one EIN number, one tax return, and it makes life a lot simpler from the accounting side. And it's true, life is so simple now. I have so much less stress. My business is more profitable. I have more free time, which is, I think, what is more important sometimes than money itself. So I'm asking you, would you like to learn how to have the same peace of mind and the simplicity in your business? I'm gonna answer for you. I think you do. Okay. So I'm going to tell you the secrets now that are going to transform your business, your real estate investing business, or just your regular business. And you're going to be blown away. I know you are. So I know I can't see you, but I'm sure, who wants to learn about these secrets now? I know that I do. So let's get into them right now. Okay. The secret number one is you set up your special trust. Okay. I use a special trust, but actually it's called a non-grantor, irrevocable, complex, discretionary spendthrift trust. So we call it the special trust or the beneficial trust. Okay. This trust is absolutely the foundation to guarantee you 100% lawsuit proof asset protection for you personally and for your business. And what the next thing you do, once you establish your beneficial trust, you want to either establish an LLC or a business trust, because these two entities are going to work together to give you those tax savings. Okay. So once the trust is formed, you are named the trustee, and you are the person that's going to control everything. And you're going to sell your personal and your business assets to the beneficial trust. So what this is going to do is it's going to create a demand note, because you're not going to sell it for cash. You are going to sell your assets and you're going to get a note, a demand note back, which basically is like a promissory note. And that means that anytime you can go to the trust and say, you know what, I want some cash, and you can get that from your demand note. Okay, so what you're doing is all your assets are being sold, personal and corporate, and they're going into the beneficial trust, and you got a demand note instead of cash. All right, and we do that because we don't want to have any taxable events in this structure. The whole idea of this strategy is never create a taxable event where you got to pay Uncle Sam, and we don't want that. So that's the genius of this strategy. So the value of your demand note will be based on cost minus depreciation of your assets. So you're not making a profit on this. So you're going by the actual value, whatever depreciation there is for any of your assets. That's how you come up with a number for your demand note. Okay. Now, as I mentioned, that long name of this trust, the very last provision is called a spendthrift provision. And that's the key provision that protects your assets. And this trust in general is based on contract law, not legislative law. And this is a very important point, because the legislature, whatever it creates, it can take away, it can amend, it can, whatever. And you can have the rug pulled out from under you just like that. And it's the nice thing is that, the very first Supreme Court ruling about this trust was done in 1810, believe it or not. And there have been a myriad of other court decisions that have been decided over this, already 2 centuries now about this trust. And where we're at right now, I can tell you it cannot be penetrated. You get 100% asset protection, which means they can't come in and do a seizure order or try to overturn assets or whatever, or put liens on income, all that kind of stuff. You can't do it because it's 100% protected, which is the only trust out there that you can give you this kind of protection. And we operate on the principle that ownership is overrated and overhyped. The reason is because anything you have can be taken away unless you have it locked down in that vault that this beneficial trust is. And my goal today is to educate you that you need to control your assets, but don't own them. Control is so much better than owning. Less vulnerability, less liability, and you get to use and enjoy your assets, but never have to be responsible for them tax-wise or liability-wise. Okay, so secret number 2 is we're going to integrate the beneficial trust with either an LLC or a business trust, and this dance between the two entities is going to save you a ton of money in taxes. For example, we're going to learn how you can take $1 million in net income and reduce it only to $30,000. Actually, I'm going to show you a smaller amount, because I know a lot of you might think that, well, I'm not a millionaire. I don't want you to think you can't use this. So I'm going to use a much lower amount as we get into this presentation, so you can see that even if you make let's say $200,000 in net income, that you're going to completely get value from this. Okay, so we're going to make your beneficial trust a 90% limited partner in your LLC or your business trust. Okay, So the beneficial trust, remember, we put all of our assets in the beneficial trust. That's where they're being protected. And the beneficial trust is where we're going to get the tremendous tax savings that we're going to generate here. But you're going to run your business through the LLC or the business trust, which is going to generate revenue and manage your business. Okay, so you see where we're going from now. I want to make sure this is, we're going step by step. You have the beneficial trust is where your assets are, they're locked down, and then you're going to run your business through the LLC or the business trust. Okay, so now the challenge that you have with trying to run your business through the LLC or the business trust is that they don't have any assets. You got to have assets to be able to generate your revenue, right? Run your business. Your beneficial trust has the assets, your LLC or your business trust doesn't. So that's a conundrum, right? Not really. What we're going to do is we're going to have the beneficial trust lease those assets to your business trust or your LLC. And that's going to be able to, your LLC or your business trust is going to be able to now use those assets to generate revenue. And so you're going to run your business like you would normally. The only difference is now it's being run through this LLC, not your S corp or whatever you were using before. And then as you know, we're going to make money. And then at the end of the tax year, you're going to calculate what your gross revenue is like you would normally. Exactly. You're going to take what your gross revenue is. You're going to deduct all your expenses, anything possible. We're still doing that. We're still trying to deduct everything we can. All right. So then, but once you have that finished, right, you're going to see that you go through the exercise here, your bookkeeper, your accountant, whoever, and then you're going to come to your pre-tax net income. And that's where things are going to be fun. So in this scenario, we're going to say that your LLC or your business trust had $250,000 in gross revenue. After we deduct all the expenses and everything that can be deducted, now we have a pre-tax income of $200,000 net income. Okay, that's the important thing. Now that we've got down to the pre-tax net income, now we can start working our magic with this strategy. Okay, so remember the beneficial trust leased those assets from the beneficial trust, right? Well, this wasn't done for free. This is not a charity. Okay, so now your LLC or your business trust has got to pay the piper, has to pay for leasing of those assets that we use to create generate our revenue. Okay, so the IRS will allow a lease payment to be made from your LLC or business trust back to the beneficial trust up to 70% of the net income of those entities, either the LLC or the business trust. Okay, so how does that work? Let's say if you have $200,000 worth of pre-tax net income, you're going to subtract 70% of that, or $140,000, and that is going to be transferred to the beneficial trust as a lease payment from the LLC or the business trust, whichever one you used to run your business. All right. So now we've taken from $200,000 of pre-tax net income. Now we have transferred 140 of that over to the beneficial trust. And so now that it reduces your LLC or your business trust net income. Now it's $60,000. Okay. So we've taken 140 right off the table. And then what we're going to do now is remember now we have $60,000 left over as pre-tax net income, but we still have 90% of that has to go over to the beneficial trust, because the beneficial trust has a 90% limited partnership in your LLC or your business trust, right? It needs to be paid for that. Right? So we're going to send 90% of that 60,000 over to the beneficial trust as a K-1 distribution. So that means that we had $60,000 left over. We're going to subtract 90% of that, which is 54,000, and that's going over to the beneficial trust as a as a K-1 distribution for the beneficial trust equity position in the LLC or the business trust. Okay. Now that leaves your LLC or the business trust with a net income of just $6,000 to determine what your taxes are. You see how that works? We started with a $250,000 worth of gross revenue pared that down to 200,000 in pre-tax net income. We converted 194,000 of that into a permanently tax deferred passive income over to the beneficial trust, leaving you only $6,000 to calculate what your taxes are. Okay. So, like I said, this beneficial trust has unique tax advantages that no other trust has, no other strategy has. And so all capital gains taxes deferred in perpetuity. Any taxes on passive income deferred in perpetuity. Any taxes on K-1 disbursements deferred in perpetuity, right? So the lease payment, okay, the lease payment that you made, that is passive income, no taxes. The K-1 distribution for the 90% for the beneficial trust, no taxes, okay? So that $994,000 was converted into tax-free money, basically. So think about 140,000 lease payment, passive income, 54,000 K-1 disbursement, no tax, right? So if you're a real estate investor, let's say that you sold a property that had capital gains issues, they're deferred. You don't need to do a 1031 exchange. You don't need to do any of that, all that stuff that you have to do before, which is just like jumping through hoops. It's complicated. You're under the gun time-wise. None of that stuff is necessary. This is so simple, and it's so elegant in how it legally reduces your tax liability, okay? And for real estate investors, the third secret is this is going to simplify your business by only having one entity for all of your properties and your assets. So you no longer have to set up this convoluted maze of LLCs and land trusts and holding companies to own your properties. It's a waste of money, and it's just a cash cow for your tax attorney and for your CPA. They're making money on this, not you. And so now you own all your properties with just one EIN number, one entity, and like I said, one tax return. So I've been a successful real estate investor, a short sale expert for 20 years. And I'm not trying to say I'm some super genius, right? I mean, I didn't know about it, like I said, until my 19th year. But if I can recognize the brilliance of this strategy now and implement it, my question is, well, can you? Because that's the thing, because this strategy is a fast track for your business to save tons of money on your taxes and get 100% lawsuit-proof asset protection. So, again, with allowing you to simplify your accounting by taking title with only one EIN number and one entity. So I would tell you right now, the time to take action.
I was trying to see where my mother at, Dolores, Kathy.
You need to take action and schedule a one-on-one consultation with me, so that way I can go over your situation and show you exactly how we can save you money. So I want to thank you guys for coming here and listening to my presentation. And now I am willing and eager to answer all your questions.
Thanks, Don. I really appreciate it, folks. What I had asked you was to type in your questions, but we have a smaller group here. We're 25 people at this webinar. So I'm thinking, Don, if you would allow us, if
Please,
you
100%.
go right ahead, and if you want to unmute yourselves.
Hey,
Hey,
have you
Annette,
seen him yet?
can you mute yourself, please?
Oh, okay. So yeah, I think
Annette?
you want to be
Just a
thorough
second.
about the
There we go. So you know what we'll do, Don, if it's okay, we'll have, if you have a question, please unmute yourself and fire your questions away to Don.
Patrick, can I ask a question?
Of course, of course.
Yeah. Hi, Don. Very nice to meet you. My name's Richard. I'm a real estate investor. I'm more on the beginner side.
Okay.
So really appreciate you giving this seminar as I'm getting started with my real estate investing journey. I have a question. So I think the reason that I learned how LLC is needed is because there might be multiple partners who want to be on title. So you set up a whole LLC, so everyone's name is on it.
Right.
If you instead you transfer all the other assets into your own beneficial trust, then what about your other partners? Do they also get added somehow to this entity?
No, what you do is you set your beneficial trust up for yourself. Okay. So you can have your partners on the LLC or on the business trust, but you would have to set up an operating agreement with them so they understand that their part is their part. honestly, I would encourage you to tell them they should get their own beneficial trust as well. Now you can run it from an LLC, but the beneficial trust, excuse me, the business trust is better. It works better with multiple partners, and it is also you have 100% asset protection with the business trust. You see, if you run it with an LLC, you have your beneficial trust and an LLC. While you're generating income during the year, you have no asset protection for the LLC or for the money going in there. You don't get the asset protection until that money or those properties hit the beneficial trust. Okay. So it's better to use both. But for some people, it's a question of, you know what, I can only afford one trust. So I say, look, get the beneficial trust if nothing else. You're going to protect your assets and you can still use this you get the tax strategies and tax advantages, but start with the LLC. And then as you save money in taxes, then upgrade and get the business trust. And then you're 100% protected. And it's easier to work with the other partners in a business trust. You cannot have set distributions and set disbursements in the beneficial trust. So, and plus, you want the tax advantages with those two entities working together. So you need to have both.
Got it. Thank you.
Sure.
I got a question.
Go right ahead.
Yeah, so when you borrow money, which entity borrows the money? And does the bank okay with that, or do you borrow it and then put it in a trust and move it over
Well, it depends on how you borrow it. I mean, we have a third part of this program where when you have this money coming in to the beneficial trust, like in this example we had was $194,000 of tax deferred money going into the business trust, we really recommend that you set up a whole life policy, and you can take huge chunks of that income, I mean, the tax deferred money, and run it, use it to fund and over, one or more life insurance policies. And then as you do that, you can borrow money from the carrier using your policy as the collateral. And then you get access to extremely low interest and tax-free money to do whatever you want. So ideally, what most of our clients do is they're taking as much as they can from that tax-free money, putting them into the life insurance policies, and then borrowing against those to fund whatever they want to fund. Now, if you're looking at other, you're funding it from your LLC, you can certainly do that. But what you want, it's the same thing. You run your business from the LLC or the business trust, and then you funnel the net income as much as you can into the beneficial trust. So in that scenario, you'd be borrowing from your LLC or your business trust. And at banks, it just depends. You have to build business credit. And that's one thing we can teach you as well, is how to build your business credit up.
Very well done. Thank you.
So-
Thank you. By the way,
so,
go right ahead, please.
Yeah, so are you saying that I wouldn't be, now, is there a way for me to sign personally for the loan, even though it's
Yes.
going to the
Yes,
because
yes.
getting to a point where your whole life has a value, how fast does your whole life have a value that is going to have enough money for you to borrow from?
With other infinite banking scenarios, it's hard to get your cash value up quickly. But because of the nature of our trust, we are able to set up policies with the carriers that they can't do. So you can get those up to 70, 90% very quickly with our policies. But we're saying that in my situation, I try to run almost everything I can through the life insurance policy. And then I can get other policies as well as I need to, as I hit limits per policy. But we're actually, I'd say probably within the next 2 or 3 months, we're going to have a whole new policy coming out there, which will basically almost have no limitation on, or no ceiling on how much you can put through. So that's going to be huge, and it only works with this kind of a trust. But yes, but let me just. So if you finance something yourself, then what you do is you can put whatever asset you want, you can put into your the trust. if you want to borrow against it when it's in the trust, you can't do that personally. The bank will say, well, you don't own it, the trust owns it. So that's going to be a challenge, right? So it's just up to you how you want to do it. If you want to use that asset as collateral to borrow money against, then you might want to put that outside the trust until you've gotten the financing. Then you can put that into the trust, and just the trust will make payments, the interest payments, the monthly payments for that financing.
Is there a time limit for transferring that over to the trust? Like within certain amount of days of selling whatever and getting that profit, or just by the end of the year?
No, I mean, most of the time you're putting when you generate the money, you can pretty much estimate on what you're going to make. And so you can get with your accountant and you can make quarterly deposits into your beneficial trust, or you can wait. It's up to you however you want to do it. That's more of what you do with your accountant, how you want to do that on your schedule of moving stuff over.
Very well done. By the way, Uncle, I think it's Uncle Charles or Uncle Joe rather. Uncle Joe says, brilliant stuff. And Selena says, wow. So I think everybody that's listening to you is impressed and really pleasantly surprised with what you've been sharing with us. Does anyone else have a question? Take advantage of the time that we have here. I have a question if nobody wants to ask, and it's a question I meant to ask you. Go right ahead. Is it someone else wants to hop in?
Yes, I just want to know. Oh, hello.
Yes,
go right ahead.
Hi, I just want to know, can I get a copy of this recording so I can go over it again?
Of course. Yes, we'll be sending out a copy of this recording later on this afternoon to you all. So you will be getting a copy of that.
Thank you.
Sure.
I have a question.
Go ahead. Go ahead.
Hi, good morning, everyone. I'm Janine. Hey, Dawn, I have a question for you about something that Ed Weinberg brought up, because I think that I think he had a point about the funding of the whole life policy. So is it possible that you could take, let's say $50,000 of your own money,
yes,
and fund that whole life policy?
yes.
Okay, so
Janine, what you'd want to do is you want to put the money into the trust and then have the trust have the trust funded.
Okay, that's good, because sometimes people have the money but they don't know what to do with it, and I was wondering about that, because I understand how whole life policies work, but I know that this is special to any kind of scenario that you could use it for, whether it's real estate or something else. So I just wanted to clarify that, because that's just awesome. So you have the ability to fund your whole life policy and whatever that cap is now to what the certain amount of whatever the new policy will be down the road. But for right now, you could take your own money and fund that. And that would be awesome, because then you can borrow against it.
Yes.
And okay, thank you.
Yes, and you really want to put all your assets, personal and business, into the trust, because you want that protection, and then you also want the tax advantages as well.
Exactly. And see, that to me, if you've got 50,000 sitting in savings, okay, oh my God, you can go put it in that whole life policy. That you don't have to pay taxes on that.
Right.
I mean,
and if you need access to it, it's tax-free money.
Right. It's brilliant. I just love this.
You guys see how, and I know for some of you who never heard of this before, it's a little bit, it may be over your head a little bit, but I'm telling you, the entire system is designed to never create a taxable event. Okay. And I've had people misunderstand this strategy, and they'll say, oh, you're telling us that the IRS can't tax that trust. That's BS. Of course it can. It's like I said, no, it can if you create a taxable event. Okay. So, but if you don't create a taxable event, then there's nothing to tax. And this is in accordance with IRS code 643. When the federal government established the tax code in the 30s, all right, the Rothschilds attorneys are the ones that consulted with Congress to set the tax code up. They already were using these trusts, and so this IRS 643 is specifically specifically or what do you call it? It controls or gives the instructions and the rules on this kind of trust. Okay, so as long as you are, you operate in accordance with IRS 643, then there are no taxable events on this at all. But if you start doing stupid stuff, then you're going to get taxed, right? No one says this is a panacea or a get out of jail free card if you're doing things the wrong way. But that's why when you invest in this strategy and get a beneficial trust, you get a whole year of unlimited consultation to make sure that you're doing it right. And you can use the CPA that's affiliated with our company if you want to do your taxes, or you can use your own, and they'll work with your tax preparer to make sure that everything is done the way it needs to be done. So you're always in the non-taxable event space, and it's not it's not as hard as you think, guys. It really isn't.
Wonderful. Hey, Don, I wanted to ask you a question. I think you kind of answered the question that I had in mind. What's the next step for folks if they're interested? What is the process? Number one, you just answered the second question, which is, what kind of support do you provide, and where, what's the next step, basically?
Well, the next step would be to get on a Zoom with me. Go to, like, again, in my in the chat we have my Calendly link. Go ahead and reserve a spot, and we can talk about this. But basically, it's a $15,000 investment to get the beneficial trust. And if it's literally all you have to do is just get with me. We'll talk about everything, and then I will have the company email you your application, and I'll go over it with you to make sure you fill it out the way it needs to be done. And then at that point in time, once it's in, you invest the money, and then you get the trust book within a week. And then you're golden, and then you start the process of selling your assets to the trust. And again, we're here to hold your hand and make sure that's all done correctly.
Understood. And all right, so that would be the next step. So you'll handhold us,
yes,
for the first year, in case, so that we don't goof up, we don't create a taxable event.
Right.
Beyond the year, can we reach out to you, or is that on a case-by-case basis?
You can always reach out to me. It's just that after that, you're not, they charge something like $300 an hour for consultations. I mean, we don't. That's the accounting firm that works with us. So hopefully, because you're getting unlimited support the first year, hopefully you reach that point where you're good to go on most of the normal questions that you have.
Great. I have a follow-up question, if you don't mind.
Sure.
What's the maximum that I could borrow against a life insurance the way that it currently is? And I know that you're creating a vehicle where it's almost unlimited. But at the moment, what's the amount?
At the moment, you're capped at $2 million. Okay. So, and you can fund, but with our policy, see, the thing is, the most infinite banking policies, you have to have a 10 or 15 year term rider along with it. And we don't have to have that with our policy, because remember, the trust is going to be the owner of the policy and the beneficiary of the policy. So, and because of the trust's unique status with the tax benefits, you can be much more creative, I suppose, with the infinite banking policy or system that other people can't do, outside the trust. Okay. So, but you can get 70 to 90% access. The cash value will be 70-90% of whatever you're putting in almost immediately. But you can't do that with other policies. It takes longer to reach that point where you can get to 70-90%.
So to piggyback on Ed's question, I think it was Ed, if I start funding that policy today, within several months, I could borrow against it.
Yeah, 70 to 90% of the cash value of the policy you could borrow against. Yes.
Super. Folks, does anybody have another question by any chance for Don?
Yeah, I have a question.
Go right ahead.
Good.
Yes. For example, I own a trucking company, which is a highly, how would you say, liability, yes, and also properties in other states.
can I combine those two into the same trust? I mean, include everything, the trucking company, the properties.
Yes, you should. Every asset you have, personally and with your business, should be in one trust, 100%.
Okay, once I include them, how will be the disbursement? Because I do have, to pay employees and just do payments constantly coming out of the account.
The trust, you as trustee of the trust pays for everything.
So we'll be under the trust and everything.
Yes, everything. Yes.
Perfect. And for liability issues, the properties that I have, I mean, I'm poster child for liabilities. I can tell you, all my properties are paying me directly to my bank account, to my personal name. So in this case, I will be avoiding any type of liability, any type of wrongdoing.
Well, you can't be committing fraudulent activities. I mean,
No.
Yeah.
No. I'm saying, for example, lawsuits or somebody falling on one of my properties, and then
Yes.
coming.
Here's the thing. Okay, so you personally, when you implement this strategy, you're not going to own anything. Okay, so if someone falls on your property, it's not your property. You're the trustee. You have nothing to do with it. They can't come after you personally as trustee. The trust, because of the spendthrift provision, they can sue you, right? But when it gets in front of a judge, you just say, look, Your Honor, this is you might want to take a look at this trust and just provide that to the judge will say, okay, yeah, you'll tell the attorney, you can't sue this trust. This is a spendthrift trust. It's the only way they can go after it is if they can try to prove that there's some kind of fraudulent activity going on. That's it. Other than that, can't do it.
The same thing would happen to for my trucking company.
Yes.
God forbid, one of my drivers,
you're still going to have
into an accident.
You're still going to have insurance policies on that stuff. They can go after your insurance company, but they're not going to come out. They can't get to you or your company because everything's in trust.
I understand.
Yes.
Hey, Don, I've got a question. This is Samir.
Yeah.
You have mentioned two things. One is the very long, complicated, drawn out name for that spendthrift trust. And you've also said continuously talked about a business trust. Are they two separate trusts that we'll have to get, or is it just one?
It depends on what you want and what's most important for you. You can use the beneficial trust and along with an LLC, and you can do just fine. You're vulnerable on the LLC side from an asset protection point of view because you have zero asset protection for anything going on with the LLC. Okay. So if like with Levan, I mean, I would recommend that he get the business trust as well if the liability is his main concern, because that wraps it up tight. There's nothing that's unprotected. But from the tax point of view, you can run it through an LLC just fine.
All right. And what is the cost of doing both the trust, the business and
the beneficial trust is a $15,000 one-time investment. The business trust is a $20,000 one-time investment. So that would be $35,000 for both. Okay. So that's what I'm saying. It just depends on what your cash flow is like and whether you feel it's worth it or not. Does asset protection on all of your assets, including the LLC, as you run your business and your cash flow and everything, is that worth a $20,000 investment? Well, only you guys can decide that. We can set you up.
That's fine. And if I set something up today for one trust and not the second one, how does that work? Does that can I set up a business trust towards the end of the year and still take advantage for the full year, or I cannot?
Yes, but you have to do your your beneficial trust first. That's by far the most important one. Nothing works without that. Okay,
which is the spendthrift.
That's the that's irrevocable, non-grantor, complex discretionary spendthrift trust. Yes, we call it the beneficial trust for short. Okay. So yes, you can invest in the business trust whenever you want. but you have to do the beneficial trust for this to work.
All right, so let's just say, let's fast forward a few months and it's November and I call you and say, Don, I didn't have the money back in July. It's November, close to December. I've got the funds. I want to do one trust or both trusts and all that. Can I take advantage of the full year, which is 2022? Or do I have to?
Not at the end. If you want to save money this year, I would encourage you to take action quickly, because a lot, you have income that has been generated for the first half of the year, and that was done without using this traction. So you're already pretty much done on that part of it. Now, what you can do is, we can I don't want to use the word manipulate, but we can use we can put a lot of the income, on the front end, on the back end of the second half of 2022, if you take action now. But if you're getting like a month away from the end of the year, you're pretty much, 2022 is pretty much lost. I mean, you're not gonna be able to get any tax savings there. You can still get some substantial tax savings. Maybe not quite as much as this. Maybe you'll pay a little bit more, but it's no comparison to what you're gonna pay if you don't do it now. If you go the entire year, then it's just like you have gone the entire year without having any tax strategy to lower your taxes.
Okay, fantastic. Thank you so much for answering my question.
No problem.
Hey, Don, I have a question for you.
Yes.
Since basically you're going to be selling even your personal house to this trust.
Yes.
Are there going to be any complications as far as the due on sale clause?
No, what you can do is someone, as an investor, Jim, subject to investing, right? So I mean, what you would do is you would go ahead and do a warranty deed from yourself or your wife, whoever's on the deed, to the trust, and then you would not record it. Okay, you would just keep that in your safe or whatever, and then whenever you need to do something with the trust, I mean with the property, sell it or whatever, then you would just go to the title company and say, hey, this was deeded back, at this time, and we need to go and do, move forward with this, and that's how you would do that. And in the meantime, the trust would make all the mortgage payments, any insurance, anything that has to do with that property, the trust would pay. It would become a trust expense.
Okay, but once the lender sees that the payments are being made from the trust, is
No,
that
that's not, I mean, the lender doesn't care what, who makes the payments.
right? Okay.
So can I piggyback on that question that was just there in reference to the warranty? So I think you and I have had a conversation, Don, where you and I spoke about warranty trust versus
warranty deed.
quit claim deed. Warranty deed versus quit claim deed.
Yes.
What I was thinking of doing is doing a quit claim deed. Obviously, that has to be recorded at the county level.
It does not.
It does not.
If you're going to do it, if you're going to quit claim it to the trust, you're going to. I mean, there's no reason to do a quit claim deed with at all. I mean, just do a warranty deed. It's better because you're warranting that the property has no issues. It doesn't have any encumbrances or whatever. Quit claim just saying, hey, this is my interest, whatever. Good luck. Warranty deed, it's a little bit, it's a better document in general. You should always do a warranty deed instead of a quit claim deed. It makes things easier when you resell the property. There's no reason to do a quit claim deed on this. Just do a warranty deed. It's going to be notarized. It's a legal document. You don't have to record it. You shouldn't record if it has a mortgage on it. Just keep it in your safe. Where you're keeping your trust books. And then when it comes time to sell your property, then let the title company know that, hey, by the way, the trust owns this. Here's the warranty deed that was signed on this date or whatever, and then they can communicate that with the with the agent and the buyer, and it doesn't matter to them, because it was there won't be a seizing issue because the deed was signed however many months or years ago. So.
Right, but a warranty deed does not have to be recorded at the county level, but the quit claim deed does.
Nothing should be written. No, quit claim doesn't have to be recorded either. Any instrument that transfers ownership in real property does not have to be recorded until you choose.
Oh, really? I didn't know that.
Yeah.
because that was my concern is if I do a warranty and or quit claim,
Yeah.
my mortgage company is gonna have the due on clause.
Do on
Say,
sale.
okay, at this
No,
point,
just don't,
go ahead.
don't record it. And listen, as someone who's been doing, subject to investing for 20 years, even when you record them, I never had one instance of a lender coming back and saying, "Oh, due on sale clause" or whatever. Now, of course, again, I'm not again, I'll reiterate what I did at the very beginning of the thing. I'm not a legal tax advisor. This is information purposes only. I'm telling my experience and what I've done as a real estate investor for 20 years. And people are out there all the time doing subject to recording. You don't have to record it if you don't want to.
Okay, fantastic. Thank you again for the information, sir.
Thanks. Great questions, Samir. Don, I have another question for you. The structure is impenetrable. I heard you in another presentation speak about you have an attorney on staff or an attorney that works for the company who has had some experience with that. Could you share that? Because I think that's really important. At least that's something that's stuck in my mind in another presentation that you had made.
Yes, it's funny. He likes to, I like when he talks about it because he's a funny guy. He said that he spent a lot of his career breaking open land trusts and LLCs and all these strategies that people sell and put together to try to minimize your risk. And he says, I'd get them. Any attorney worth his salt can break anything. He says, I couldn't break this. So I can't break this one. And so he became a client, and then the company said, well, listen, we'd love to have you on as a consultant to our company, and you can be, someone that can help, talk to people from a legal point of view while they're still considering whether they should do this or not. And he says, yeah. And I've used him a couple of times as well with some prospects who, that was a big issue for them. They just want to make sure from a legal point of view that it was sound. And he says, yeah. He says, I couldn't get it. I can't break this trust open.
Understood. And so if somebody is interested in going forward with you, they could address those questions, whether they're legal or tax or accounting questions, to somebody at your end.
Yes.
Very well. I think everybody will agree this is different. It's new, and yet it's not new, because as you mentioned, the ultra wealthy have been using this for years. Does anybody have any last questions? And if
Yes,
not,
this is Reggie. Okay,
yes,
so Don, for us that hold a license to be able to help out on the back end as far as the policies go, but if I'm very unfamiliar with everything as far as the trust, is there something that we can study, that we can familiarize ourselves with the trust, so we'll know how to put things together?
Yes, 100%.
Okay.
Yeah.
Alrighty.
Do we have a Pace Morby person in our audience?
I think James Brown is with us. He's James. Can you unmute yourself? You're part of that universe, I believe.
Yeah, Toby and he's also.
Yes, correct.
Okay. No, I like Pace's stuff. I saw your hat. I was like, yeah, okay, cool.
It makes three of us, guys. There's a Samir, and it makes three of us.
There you go. There you go.
Okay, there you go. Yeah. So
Pace's ear must be ringing.
Or what is it? His ears are burning, right?
Burning, that's the word. That's right.
Right. Janine, would you mind just basically, when we were at the other event, you were talking about how, your background and, your trust background and everything, and just maybe give your opinion of this. I think that would be, people would be interested in hearing about that.
Oh, yeah. So I'm a paralegal by trade, for those of you that don't know me. And I worked in real estate probate for 23 years. And then I started doing trusts for people to take to their, to their lawyers for review with pour over wills into a trust, and with all of the necessary documents for medical and things like that. Okay. Now, I've known about trusts and worked in them extensively over 20 years. And what was bothering me is that when I met Dohn through Patrick, I heard about this, first of all, I'm a research person and I go deep. And when Patrick, introduced me to Dohn and I heard about this the first time, it was like, this doesn't sound right. This doesn't feel right. I need more information, and similar to what Reggie was saying. And so I interviewed with Dohn for about 2.5 hours, and we talked, and I'm pretty straightforward. And I asked a lot of questions, and Dohn, and then when he sent me all of the information on it, I went into the deep dives. I went to the company, I interviewed the company, because I want to know that what I'm doing is going to be in my highest and best good for my businesses, number one. But number two, I need to set up my legacy for my family. So when I go, my businesses can still continue running. And that's important for me because I know that this will do it. But the most important thing I think everybody needs to understand with this is that this perpetuity clause that's in this thing, for those of us that do real estate, and for those of us that don't know this, but CPAs are really not good to have in working with your business, because CPAs can be interviewed by IRS and they can literally turn state's evidence. If you're doing something illegal or there's any red flags, they get called in as a witness, and bada boom, bada bing, you've got your CPA testifying against you in IRS court, if you will. But with a tax attorney, that's not possible, because attorneys cannot be subpoenaed by IRS to testify against you. So you always in real estate want to have an attorney and represent you no matter what. In IRS, you never use your CPA. You can have your CPA do stuff, but then on the flip side of it, if you're doing real estate, that's just not a good idea. So one of the things I started looking at is how is this trust going to operate from a tax perspective? And this is literally so legitimate. It's not even funny, because the tax law, you have to remember something. Here's the thing about law that people don't understand, and I can express it in the most simplest form. People say, and you've probably done this yourself, oh my God, this is a cut and dried case. We've all said it. But guess what? That's black and that's white. But that's not how law works. Law walks in gray. That's the pathway. Law works in gray. So when you go to your attorney and say, I've got this cut and dried case, they're going to look at you and go, yeah, it's not really that simple, because the lawyer knows that the case is in grace. It's about finding the rules and the regulations and the law that can keep you in that gray area so you're not breaking it. That's how IRS was set up many, 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 many years ago. These laws that they're already there. They're there for us to use. And this company has developed this trust that literally protects your assets in the most incredibly dynamic way. We're not avoiding taxes. We're simply deferring. We're going into the perpetuity place. And people, I'm telling you, I am so sold on this. It's not even funny. And I am not one of those people that is easily sold. I need to know that you're going to own up to who you are. Your word means a lot to me, because a lot of people do this. And I'm not about that. I want to know. And so I'm just saying, this is definitely an incredibly dynamic program. It's worth every penny that you can invest into it over the long run, because if you can get your assets protected and do exactly, by the way, Dohn, you forgot something, I think. Don't you do the mapping when you have that interview? Don't you sit down and do mapping for that person with all of the assets so they can actually see how that works for them? I can't remember.
Well, that's what we do when we do our
yes. Could you go into that a little bit more? And I'll put myself on mute, because wait till you hear what Dohn can do for you with this mapping thing.
Well,
And by
it's,
the way, Don, before you start, I just want everybody that's here, and those of you that are going to listen to this webinar, the repeat of the webinar, Janine is kind of the Erin Brockovich of the real estate investment world. She's got tons of experience, but beyond that, she single-handedly is set up and spearheaded a massive lawsuit, which a couple of weeks ago she got some good news. But just briefly, in a sentence or two, tell us a little bit about that, so people can understand your experience and why you are the Erin Brockovich of real estate. By the way, you're on mute, so you might want to unmute.
Oh, so about 8 years ago, I headed a lawsuit against Armando Montalongo Seminars. It's just how it is. It's public record. And we just won a massive Supreme Court decision on a decision that has been pending literally for 3 years. I manage and case file manage 427 clients in this case. And I want you to know that my passion for people and doing what's right and what's in their highest and best good is at the forefront of any work that I do. So when I do say that I research, believe me, I research to try to understand what's going to be in the highest and best good, not only just for them, but for any business that I work with. So when we won this, I was like so excited because it was important to have this win moving forward, because these people have been on hold for so many years waiting to get something done with this situation. Now, that's because of my background and my law clerk and my understanding of title and working with real estate investors and all of that. And that's just one part of some of the things that I do just on the legal aspect. And I'm in that now. So I guess, I hope I answered the question, Patrick.
Yeah, thank you. What was the amount? What was the exact amount, by the way?
The case file just without treble damages is worth $111 million.
So Janine knows a little bit about what she's talking about. Thanks, Janine. Hey, Donna, I'll let you go ahead and answer Janine's question.
oh, it'd be about, I forgot what it
Oh,
was.
she was saying about how the
The
onboarding,
mapping.
onboarding
Yeah,
for
yeah,
clients.
yeah.
Yes.
Yes, what we do is we go through and, part of the application, part of setting the trust up is to go over all those assets and so forth. And we show how how that works, show you what the valuation should be. And then we'll go through, your previous income, and just map through about, okay, now, what is your estimated income going to be this year? And we'll go through and just show you, okay, you had this year, last year, and we're going to show you what it was should work out to be this time. And it's a little bit more in depth than what we did on the presentation, but it's very similar in that sense. Is they're going to show just how powerful this is. And what I just want to say is that you're not going to be left, getting a trust book by FedEx and saying, okay, best of luck, hope it works out for you. It's not that way.
Great.
Honestly, it'd be poor marketing from our point of view, because a lot of the referrals that we get come from happy clients. And we want you guys to be happy. So, and you guys are walking testimonials of the power of this system. So, what I do want to say, getting back a little bit, circling back to the IRS part of it, is that the accounting firm that's been working with trust and advising people on doing their tax returns for since the 1960s, believe it or not. They've done well over 10,000 tax returns in that period of time. Not one instance of an audit, nothing. Okay. And there have been a few instances where they had some taxable events that were done because they didn't follow what they were supposed to do. And even then, the IRS was just focusing on the event. They never once said anything about the trust or the strategy, because remember, this was all vetted by the IRS themselves to make sure that it was compliant with 643, IRS code 643. So they know about this. And it's just that people have a little bit of disbelief or, worry about it's too good to be true, like I said in the presentation, just because they don't know about it. And as human beings, we seem to be conditioned to, if something is new, we immediately put our guard up and try to find reasons why it would not work, when actually, even if something's been around centuries like this trust has, and since the birth of the IRS tax code in the 30s, this has been around for a long time. So actually, we're talking about decades and decades and decades of this system being in place. It's just we didn't know about it. But the
Wonderful.
system has been there, and people have been, people with money, lots of money, have been able to use it for their benefit. And now I like to say we're democratizing this strategy a little bit here. So those of us who are not millionaires, or even the ones that are and the ones that aren't, we can all equally share in the benefits of protecting our assets and not paying so much to the IRS.